Coming amidst a US shutdown, of course, we haven't seen much by way of data out of the US, but it's not long until we see the Federal Reserve having to make their decision in terms of whether to cut rates this month, and therefore this week's upcoming CPI release out of the US really will take precedence as the main event of the week. So let's look into what to expect for this release and what implications it could have for the likes of the Nasdaq, the US dollar, and the price of gold. In terms of market expectations, we can see that there is a view we will remain the same on a monthly basis for both the core figure and the headline figure. This is a month-on-month basis. That essentially drives the year-on-year headline number higher and the core figure lower. And this really highlights the sort of impact of base effects coming into play. But certainly, with a sort of big or sort of wider view coming into play, you're looking at a move to 3% across both of them. But when you look on the more granular nature, and I always focus on the sort of monthlies, you've got to look at last time around 0.3 coming into another 0.3 this time around for core. And that headline 0.4 followed by 0.4. Remember, the target is 2%, right? So you're talking about 0.8% worth of inflation in just 2 of the 12 months. That's problematic. Of course, markets at the moment do expect to see rate cuts from the Federal Reserve. But that's because we haven't necessarily seen a major uptick in terms of price pressures. It is certainly a gradual uptick. And I'll show you exactly that in the following charts. Now, first and foremost, we can see here in terms of the current picture for inflation, there has been a gradual increase, most notably within the headline CPI figure. It's at 2.9, but it has been climbing from the lows around that sort of 2.4, 2.5 area. The core CPI figure didn't really bottom out in the same degree, but it's not really gained ground to the same degree either. If you look at the monthly metrics, that's where it's really important and interesting. You can see in the middle section that there has been a growth. Since that low in March, we've seen inflation really start to gather momentum on a month-by-month basis. So that increase is concerning. It really makes you wonder how far it is going to move towards the upside. Perhaps it doesn't continue to increase and it flatlines. And that's kind of what markets are expecting this time around, because they think both core and headline inflation will remain 0.3, 0.4. But what the impact is in terms of the trajectory of inflation can be seen at the bottom here. I've taken a 3-month annualized view, which essentially says if you look at the previous 3 months, and turn that into a yearly figure, what pace are we on at the moment? And the pace or the rate of change that we're seeing in terms of those monthly figures at the moment have core moving to 3.6 and headline moving to 3.5. So ultimately, we can very clearly see that things are running relatively hot more recently, and they continue to climb. So if we do see a 0.3 and 0.4 as markets expect, it's kind of more of the same. Whilst we might look at the year-on-year figures and say, oh, they're at 3%, it's not problematic. Those underlying metrics do tell a different story. Now, this sort of flies in stark contrast to what's happened with the UK. I provided a video like this, sort of alluding to the fact that whilst the year-on-year figures don't look great, the monthlies are telling a different story. In actual fact, the monthly figures even came in low. So it really painted a picture of inflation in the UK really being more under control than many do perceive. If we're looking at a 3-month annualized view, I just wanted to look at that and compare it against the 6-month annualized, the year-on-year. And it highlights the fact that if you look at the month-on-month, that's one way of looking at it. And like I say, when these releases come out, I always look at the month-on-month. But then, you're going to get variation on a single month, and you want to know what's been happening more recently, but not necessarily just a single month. So the past 3 months, what kind of pace of inflation has that got? And then the past 6 months, and then the year. And it sort of highlights the fact that essentially this 3-month annualized figure will typically show you the breakout before the others. So you can see that previously on the way up back in sort of 2020 to 2021. You can see that it was that green line really leading the way. On the way back down in sort of 2022, you can see the green line sort of dropped sharply before the rest followed. It stands to reason that essentially it's going to reflect the inflation trends sooner. Now, what are we seeing at the moment? Well, we're seeing this sort of rotation for the 3-month annualized at the moment, and that points to why we've got the year-on-year figure essentially sort of treading water in the middle of that sort of oscillation for the 3-month annualized. So we haven't necessarily seen a breakout towards the upside like we've seen in the past that would signal a significant surge in terms of inflation. But nonetheless, there is the potential narrative of that coming into play and implications, of course, if that were to happen. Now, if we look at inflation in terms of the sort of good side of things to services, notably services inflation was the big problem for much of the time, where goods inflation sort of completely collapsed. But now goods inflation is starting to make a comeback, and certainly there's question marks more recently around who's paying these tariffs, right? So the tariffs have come into play. If we don't necessarily see major goods inflation, does that mean that the exporter is bearing the cost? Is the importer bearing the cost? Is the end user bearing the cost? That remains to be seen. But goods inflation turning upwards once again, but still services inflation really is the major problem within this. You can see within the breakdown for both the ISM manufacturing PMI and the ISM services PMI, it's the services PMI that is more elevated. In actual fact, the rebound that we've seen in terms of manufacturing PMI prices paid has started to fade somewhat. So both of those blue lines are the prices elements of the ISM PMI surveys set against a 6-month lead against the other metrics I've got here, which are those 3-month, 6-month and year-on-year. So the annualized figures and then the year-on-year figures. So as we can see, that 3-month annualized turning upwards, much like the chart before that. Is that going to replicate the surge that we've seen, in particular for some of the PMI numbers, which were most notably, it was the manufacturing figure that rose sharply initially, whereas services sort of has been moving higher, but it was already relatively elevated in the first place. A different way of looking at it, remember, we're looking for different ways of looking into the same kind of data and giving us a clue of where things could go. These are manufacturing surveys, the Philly Fed, the Richmond Fed, the Empire State, the ISM, I've put in there as well, and then overlaid with inflation data. So we have seen a surge in terms of many of the prices paid elements within these surveys. That has yet to really significantly push inflation higher, but we are still seeing inflation start to turn upwards as we've seen in previous graphs. So the question mark here is whether we see that resurgence. And like I've said, the first thing that we're going to see is the monthly inflation surging. That's going to push the 3-month annualized figure higher, and that's where we can really see it in a meaningful manner. We are seeing it turn upwards, but we're not seeing it spiking in a meaningful way. If we saw 0.4 for the headline month-on-month figure, then again, that really should provide that extra push to further extend that rebound over the near-term inflation metrics that eventually should push the year-on-year numbers too. In terms of sort of segmenting the data, what we can see here is if you segment it in different ways, many of them all show a similar kind of thing, and that is that we have been seeing a gradual increase in terms of inflation pressures. The caveat here is that shelter, which makes up a third of CPI, actually has continued its downtrend. And if you look at the peaks that we've seen back in 2022, shelter peaked sometime after the rest. So it's the kind of thing that is pretty lagging in nature, and we're seeing exactly that now. The rest of the different metrics turning towards the upside, but we're not necessarily seeing that quite yet in terms of shelter, which by and large, given how heavily weighted it is, has provided some downwards pressure on that headline inflation rate as we see the others moving towards the upside. In terms of market expectations, we can see that by and large, markets don't expect to see too much next year compared to this. This year is pretty much nailed on. So this year, supposedly, we're going to see a rate cut in October and December, according to this Icon platform. So 99% chance of a cut in October, 93% chance of a cut on the 10th of December. Of course, the big question marks really turn to next year because whether this inflation gauge is going to be enough to knock these near-term rate cuts off the table, that remains to be seen. It'd have to be quite drastic, but it can make significant implications or impacts on the rest of this data. 57% chance of a cut in the January meeting as well. And then from there onwards, you're sort of looking at a good chance that we see one more rate cut next year. But there's big caveats to that. First and foremost, we don't have the data to really inform us too heavily about the back end of next year. Secondly, we don't know who's going to be in charge of the Federal Reserve. And I think there's a good chance that it's going to be someone that's relatively dovish, considering they're being appointed by Donald Trump. So I think this is relatively conservative at the back end of next year. So the question mark is, are we going to see rate cuts coming into fruition at the beginning of next year? That's going to be the thing that is a question mark. And then at the back end of next year, you're going to get a new Fed chair who is likely going to be promising plenty in a bid to try and get the position, and that means the possibility of additional rate cuts. So I do think there's going to be plenty of rate cuts ahead, but much of it comes down to the beginning of, or the first half of next year, before Jay Powell leaves. Because if we also see rate cuts throughout that period, then I think there's a good chance we also see more rate cuts at the back end of next year. And so this inflation release should be key for that. Now, in terms of the charts, let's look first and foremost at gold. This, of course, has been the big story of the week. Absolutely massive collapse taking place on Tuesday, over 5%. Down for the day. Then we followed that up with another day of downside for gold. You can see here trendline support at the moment has been broken. From a wider context, you can see, look, it's just run so heavily. We're going to see some sort of snapback at some point. It's difficult to know whether we're going to see this kind of move, though. Are we going to move into a new consolidation phase? Not sure. But certainly from a wider perspective, I still remain bullish. I just don't know if we're going to enter a sideways consolidation, pull back and then sharply move higher. But I still do retain that bullish outlook. For the near term, keep an eye out for 4,000 essentially, and then 39.43 as your near-term support levels. But that 39.43 level is really key, because if it breaks, it points towards open air beneath for a potential wider retracement coming into play. Of course, if we see hot inflation data, that's bad news for those expecting rate cuts, and probably bad news for gold as well. In terms of the Nasdaq, again, if we do see hot inflation, that's not going to be good for the likes of the Nasdaq, quelling those rate cut calls. And so with the fact that we've rallied up into trendline resistance and then rallied up into horizontal resistance, there's a good chance that we sort of falter back towards trendline support here as we trade throughout this rising channel formation. From a wider context, of course, the trend is still bullish. And for the near term, we'd need to see a breakdown through this near term swing low of 23979. If we see a break below that level, that's when it looks like we're going to roll over in a more meaningful manner. And until that happens, near term upside is likely to be capped. Near term downside is likely to be capped by the likes of this ascending trend line. But keep an eye out for that inflation data in particular. We'd need to see something pretty concerning to take the likes of the October or the December rate cuts off the table. But nonetheless, it's all about next year as well. And then we've got the US dollar. It's an interesting one. Look, frankly, we've been trading within periods where we see inverse correlations against yield differentials. Then we see the positive correlation as well. And now, where are we? I mean, look, in a way, we're kind of following this yield, this differential. Are people going to be expecting to see a slower pace of easing from the Federal Reserve, and that bolsters support for the greenback? If you look for the near term, we have pulled back into the 76.4 fib, or just shy of it, and now we've been moving higher since then. So if we start to break down again, I need to see a breakdown through that right shoulder bottom, which is around about 98,000. If we see that, it points towards this sort of sloped head and shoulders formation. But certainly for now, we are in this sort of recovery phase following what looks like a sort of flatlining bottom here. So as we see these pullbacks and rally, pullback and potentially rally, the question mark is, do we see that breakdown and where you start to take out levels seriously enough to point towards this market continuing that wider trend? For me, there is a big chance that what we're seeing at the moment looks like some form of basing or bottoming pattern. But let's see how it plays out. Of course, you need to break through the likes of the 99.5s and the 100.2s to really gain confidence that we're going to see a protracted move higher for the US dollar. I hope that's been useful for you guys. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading.